Hello, I want to thank Cheryl Umberger for coming on with us. Cheryl is a vice president of Construction Loan Division at Homeside Financial. And it's a pretty new title for you. Congratulations. I know that was super and well earned because you've been doing this for a long time. Cheryl is the one that we would always go to, and she would teach our classes for this. And we're like, Cheryl, help, I have a construction loan. How do we do this? So I just wanted to ask her for a few minutes of her time so she can kind of walk us through what the construction loan program looks like. Okay. Cheryl, thank you so much. And let me just ask you the first question right out of the gate. What's the number one thing a borrower needs to do when they're looking at doing a construction loan?
They need to get pre-qualified. That is the very first thing they need to do. And part of that pre-qualification, the reason that it differs on a construction loan than it would on any other loan, you're still going to do credit. You're still going to talk about income. You're still going to talk about assets. But in many cases, what a borrower really wants to know is, hey, I own my home now. Do I have to sell it before I can build my house? When do I sell my house? How does that flow? You know, do they have their own piece of land that they own currently, or are they buying a piece of land? And if that land is in a development, that might be different than if that land is what we call a scattered lot or stands on its own. So that pre-qualification conversation with a loan officer like you, Bruce, is so very important because it helps people to know not only are they credit and income qualified, but how is this going to flow for their lives, right? Like, where do I have to sell my house first? If I have to sell my house first to use the money out of that house to put down on my new house, where am I going to live? Exactly. Or can I qualify holding my current house and then sell it sometime in the process? And then maybe I start out with a higher construction loan, but when I go to modify my loan, I'll have my house sold. I'll have a little bit of extra money in my pocket. I can pay my loan down then.
Great. I appreciate that. Can a borrower do the loan recast? If they sell their home after, they can still come back and use the proceeds from that sale to pay down, and they don't have to refinance. They just pay down their what their loan amount is, and that lowers their payment, right?
Yeah, and what actually happens on a construction loan, remember, you're going to go, the difference is on a construction loan, you go to the closing and you basically buy a big pile of dirt for a lot of money, right? Because there's nothing there when you go to closing, but all the money comes in at that time because you never have another closing. We only have a modification. So let's say I sell my house, about 6 months into my construction, and then my house finishes sometime, a few months later, and I'm ready to modify my loan. Well, if I borrowed $400,000, but now I only need $300,000. I don't even have to go through the recast process. Oh. I can just reduce my loan amount before we modify into a permanent mortgage. And that way, right out of the gate, my payment is lower. But let's say I did have to modify and I only sold my home later. I certainly could recast my home later.
Okay, great. So number one, pre-qualified, just like you would for any loan. Secondly, get a lot of questions about the builder. How do we know what builder we can use? Can I use my builder? Would you address that, please?
Yeah, sure. Absolutely. We encourage, the borrower chooses their builder. At that time, if it is not a builder that we've worked with before, we ask the builder to fill out, it's basically a 2-page form. It asks for references. We get some general liability insurance from the builder. We get a license from the builder, all those kind of things. And then we run that through our third-party vendor to accept the builder. And assuming the builder is in good standing and there are no issues, we will accept the builder. And then you're good to go. That builder is on our list. The borrower is free to proceed. Once the borrower has their final contract, which it's fully executed, it's the final price, plans and specs. Then we take that and we review that project. We also have our third-party vendor review that project. And once that is all accepted, we're good to go.
Okay, great. Thanks for answering that. So I guess a little bit about the process. They've been approved. We got there. And by the way, I just want to mention this. We do have a builder packet that we send out to the builder that outlines our process. And we have the borrower packet. So it's a detailed packet that we'll send to you. And so if we're not answering all your questions here, a lot of that will be answered. So after we have our vendor, the builder, we have them in our system, they're approved. We've got the loan amount approved. Let's step back just a bit. What if they already own a lot? Can they build on their own lot?
Mhm. Yeah, if they own the lot, then essentially we can use the equity in the lot towards our down payment and closing costs.
Okay.
And that's a question that we get commonly, right? Like, well, I bought my lot and I don't want to have to come to closing with a bunch of money. As long as we have enough equity in that lot, we can raise the loan amount up enough to cover not only the building costs, but the closing costs. So
And that doesn't
borrower-
require a refinance of that lot?
No,
Okay.
no, because they already own the lot.
Great.
So we're doing the construction loan on the lot. If it's a conventional loan, it's considered basically a refinance. If it's an FHA or VA loan, under all the terms of FHA and VA, any construction loan is considered a purchase. And so we talk a little bit more in detail with those borrowers about those details. But yes, you can build on your own lot if you already own it. And let's say you own it, but you have a loan on it. We would pay off that land loan.
Okay.
And then it would all be encompassed at the time of the construction loan closing, because our loan has to be in first lien position. So we would pay off any existing loan, include the cost to construct. And if there's enough equity, we would roll the closing costs in as well.
Super. Okay. So let's say then they don't have a lot and they're coming to us going, hey, we're looking at moving out in this whatever part of the United States they're moving to, out in a rural area. They're buying a lot and they haven't found a lot yet.
Mhm.
So how does that work? Are they looking for a builder first? They're going to buy a lot first. They're going to do it at the same time. I know there's probably several ways to do that, but I know we get a lot of questions about
Yeah.
that. So please
Yeah.
address that.
So it's a different world than it used to be, right? Because properties are all hot, no matter what they are. So a couple of things. Most often, borrowers in those circumstances will have an idea of which builder they want to work with. And then they find the lot. And if you find your builder first and you kind of have an idea of what house you want to build, then you find your lot, it's a little bit easier at that point for the builder to do kind of their magic to make sure your house will fit on that lot. And then you would have a lot contract with, let's say, ABC guy, right? Mr. Smith owns the lot. So you're going to write your contract with the lot. It usually has to be a longer settlement time than a typical contract, because if you're buying a lot that the builder does not own, you could have lot improvements like your well and your septic and those kind of things. And there's a little bit of work required to determine where you're going to put all that. Can you put all that? Can the house fit on it? So I usually say to a realtor that would be working with a borrower, write a 120-day lot contract.
Okay.
And that gives the borrower time to go back to the builder and say, hey, guess what? I found my lot. I just need you to make sure you can put my house on that lot.
Right.
So let's get our final plans and specs, and that way you can close both of those things. It's all done at once on the construction loan. What I sometimes see is borrowers will find a lot and they write a contract, but they haven't chosen a builder yet. And you really can't go to closing with just the lot because it's not a land loan. We don't do that as a general rule.
Right.
And the reason we don't is because it costs a lot more money for the borrower to do both. So it's really important for timing when you're looking for the lot. So kind of having an idea of who your builder is going to be and having an idea of what house you want to build is important, but you probably are going to have to find that lot in order to make sure you can build that house on that lot.
So you mentioned the builder plans. Is that part of what they're going to be sending over, and where does that come in? At what point?
So remember, we don't take you're going to do your pre-qualification, right? All that kind of stuff is done, but we don't take the actual loan application until the full contract, plans, and specs are done.
Great.
So let's say they have a lot contract and now they've got their building contract, and now they have their plans and specs.
Okay.
All of that would be sent to you as a loan officer.
Mhm.
You would take the loan application. And the reason that we can't take the loan application until we have all of that is because we can't order an appraisal. And a common question that I get is, well, how can you do an appraisal? There's no house there. But we're doing the appraisal based on plans and specs.
Wow. Okay.
Because down the road, we're not doing another appraisal.
There's
What's
not. That was going to be my next question.
Yeah,
Okay.
we're not doing another appraisal. All we're going to do when the house is done is we're going to ask the appraiser to go out, and he's going to say, yep, they built the house they said they were going to build. And
Okay.
the value is still there.
Great.
So it's just typically a final inspection. Now, there are some rules to that have recently changed, but we won't go into all that. But
All right.
typically speaking,
I don't
you
want to
go
keep
through
you
the-
all day.
you don't want all the gory details. Typically speaking, you're not doing another appraisal. We're doing the appraisal based on plans and specs. So sometimes I get questions from people where they'll say, hey, I don't quite have my final numbers, but I want to get going. Well, we can't, because there really is no point for us to try to order an appraisal until you have those final plans and specs. It's so critically important that we provide the appraiser with those details. Otherwise, you run the risk of not getting your appraised value and therefore not being able to finance everything that you want to finance.
Okay. So once that's set and done, what if there's they're building and they decide there needs to be some sort of modification to that plan? What happens there? Are we having to re-qualify the whole thing, new plan set? Oh, the office isn't going to work on this side of the house. We got to move it over here, and it's going to be a little bit bigger with a little bitty patio. What happens there?
Man, you want to drop a bomb today and get all the tough questions out there.
Just say no.
Yeah.
That doesn't. It's not going to happen.
It's not going to happen.
All right.
So, I mean, here's the shortest answer I can give you on that.
Okay.
That our construction loan agreement basically says, hey, Mr. and Mrs. Smith, you have provided us with the final plans and specs. Any changes would be, any costs of those changes would be out of your pocket, and you can't make any changes unless you notify us and we've approved them in the process. So the short answer is it's really, really hard to make changes after you go to closing. So that's why I can't stress enough that taking the time to get your final plans and specs in order before you go to the construction loan closing is very, very important. What we are seeing these days that in 25 years, I never really saw much of, we're in an environment where the cost of goods is going up a lot, and it's hard for builders because they try to build in those costs and they try to give you a fixed price contract. But when your lumber goes up 130% unexpectedly, this is a problem.
Yes.
So some of the ways that we see builders trying to make sure they're accommodating that is they'll put right in their contract that there is a contingency, and it could be 10. Recently, I saw 20% contingency. And what that means is they're going to set aside this money, and it's either going to be in the loan or it's going to be money that the borrower brings to closing to cover potential extra costs.
Okay.
Previously, we really didn't see a lot of that, but in the environment that we're in, where it's happening much more frequently, builders, your very reputable builders are trying to combat that by getting some contingency in place up front.
And a question on that, can that go either direction? What if their cost drops 20%? The lumber cost.
Yeah. Actually, remarkably, I just modified somebody, and their cost to build was about, it wasn't huge, but it was about $4,700 less than expected. Great. In fact, it was in Texas. Thank you very much. So what we would do at that time is we just take that extra money and we apply it to the principal balance of the loan before it modifies. Okay,
great. And we'll get to that modify point. So then talk a little bit about the process, the phases, because I know it gets paid in stages, and there's an interest only loan that they're paying on as the loan starts getting paid out to the builder. Just talk a little bit about that if you don't mind.
Yep. So unlike a regular mortgage, because it's not really a regular mortgage yet, we're not giving all of the money all at once. We're giving little bits of the money over time. And those are called draws. So the builder will take draws as they complete the work. So we typically do not fund a builder until the work is completed. So if they pour the foundation, they request the draw, we pay for the foundation. Now, once we issue that draw, the borrower then will owe interest on the amount of money that we have drawn. And so each month their bill starts out pretty low because
Right.
it's either no draws or a small draw. And then as the builder builds a house, the payments will go up and up and up until
Right.
finally the last draw is issued. Typically, there could be one more interest payment due, but we try to modify the loan to the permanent mortgage as quickly as we can after the final draw. I generally tell people that takes about 2 weeks to modify. And then their regular mortgage payments would start.
And it's a different interest rate while they're taking the draws. Now, you did mention that first draw is smaller, so I'm only paying interest on that. And then the next one, and you're paying interest on that. So you're paying a little bit more gradually until you get to the loan modification. So now we've done all the draws. They've been paying on that higher interest rate, which is a little bit higher during the build period, but it's a short period of time. And then it's going to modify to their fixed rate for the life of the loan. Mm-hmm. So just speak to that just a little bit.
Yeah. So the big question there is, what is my final payment going to be? Yeah. And what is my rate going to be? So that wasn't so much of an important question last year when rates were in the 2s and 3s, right? But now we're in a rising rate environment. So number one, we will always charge a rate that is a little bit higher than the going market rate during the term of construction, because it is a temporary only, it's just interest, temporary kind of loan. Okay, works very similar to a line of credit where you would expect to pay a higher percentage of interest. However, that is not the rate at which your final payment is calculated. So it's super important to be in touch with your loan officer throughout the process. We do have options where you could do a long-term rate lock for up to 1 year, because our construction loans are a 12-month period, which we'll talk about what happens if you go over that. You could lock your rate in for 1 full year. We do charge fees in order to do that, because any lender that will lock a rate for that long, they're getting charged on the back end. So, honestly, even in a rising rate environment, I typically don't see a full year of a rate lock. 6 months is kind of common. That's why I say it's important to talk to your loan officer throughout the process. And we offer a float down. So let's say I do lock my rate in, I'll just say for 9 months, and I pay, I think it's 1% upfront to do that. And I am now within 30 days of modification. My house is just about done, and I'm ready to modify. If the rate has gone down, my rate will float down.
Okay.
If the rate has gone up, my rate will not go higher than my locked rate.
Okay. That's a good thing to have, and especially in this environment we're in now, that where rates are going up. Great. So I appreciate that information. So during that modification period, so you get the builder's going to give them the certificate that says it's ready to move in. What's that called again? Tell me that.
Certificate of occupancy.
Certificate of occupancy. They get that. And now what?
So what usually happens is you're going to get your certificate of occupancy right before we issue the final draw. And the builder's going to give you the keys and you're going to move into your house.
Okay.
But we still have to modify your loan. So I jokingly say you're not quite done with me yet. Probably another 2 weeks, because we do a couple of things after that final draw. For example, in Texas, a final survey is required. So we have to obtain the final survey if it's required in that municipality. We have to get a final title endorsement. So those kind of things take a little bit of time after the final draw is issued. So I usually tell people, you're going to be in your house, you're going to be happy, and we still just have to talk for a little bit after that until you sign your modification documents, and then your loan goes over to the permanent mortgage.
Just a few last minute things. So you brought up a good point. This is a 1-year deal. So it's important for these folks that are thinking about buying a lot and they want to do a one-time close. And that's what we're talking about. Here's a one-time close, which is easier for the borrower. It saves money, but you have to build in that 1 year. So if the borrower's thinking, well, let's buy a lot, and they call me or one of our loan officers and they want to do this loan, we have to tell them, that's great, we can do that, but it needs to be part of this package where you buy and you build in that 1 year period. Now, I understand there's some construction delays, we're having supply issues. And so what happens in that situation if we go past that? Now, I don't mean where they're intentionally saying, we're going to push this off, but they understand they've got to do it in 12 months, but there's builder delays.
Yeah. So at the end of 12 months, we're going to send out an extension request to both the builder and the borrower. And we're going to say, hey, Mr. Builder, what is your new completion date? Generally speaking, up to 18 months, we aren't really charging a fee to extend the loan. But beyond that, we would probably start to charge the borrower extension fees on the loan. So, we understand there's a lot of challenges right now, which is why we kind of say, okay, let's look at that 18-month mark as a potential extension mark. Most of your reputable builders want to finish in that 12-month mark, and barring any real supply shortages, most of the loans finish in that time. The ones that are extended, usually 18 months, will give you. I just talked to a builder and he said, what do you do in this case, and really 18 months will generally cover.
Are they, then it's kind of on the borrower to have a contract with the builder that says if there's delays, who's responsible for those types of fees? Is that something
that is included in our construction loan agreement. And as far as from where we stand, that would be the borrower's responsibility. So, that starts to they have to work with their contractor on that. The caveat here is there are some differences if you're doing a conventional loan versus an FHA or a VA loan when it comes to extending your contract. Yeah. So if you have a VA loan and you included interest in your contract, which you should have done, then that was only good for a year. And the VA guideline says that the borrower cannot pay any additional interest. So you have to figure out then, hey, Mr. Builder, it actually means that you are paying the interest that's not maybe included here. So those are the conversations that on a VA loan in particular, if you're doing a one-time close, if there's any chance that is going to go over 12 months, I strongly encourage a builder and a borrower to include 18 months of interest. And if it's not used, it gets credit back to the borrower, right? But it's building it into the loan and into the contract up front saves a lot of headache at the end. The challenge is on a conventional loan, when you go over 12 months, you're going to need a new appraisal. Most likely. You can do a one-time extension to that appraisal for up to 16 months.
And it doesn't matter that the appraiser's already coming back when it's done. It's still 12 months. You got to have a new initial appraisal.
Yeah, they're going to require a new appraisal. So all of that plays into your rate lock, right? Because that means that it's going to take you longer to modify your loan and longer to do some things at the end. So it's just really, really important that you stay in touch with your loan officer and that the loan officer stays kind of on top of the loan, especially as you're getting to that 12-month mark. Because let's just say it's only going to go to 13 months, right? Well, if the loan officer orders a recertification of value, and gets that appraisal to that 16th month mark, then maybe you don't need a new one, right? And make sure your lock time. So there's a whole bunch of things that come into play when it comes to extensions. That's why I say case by case, borrowers and loan officers really have to stay in contact.
Yes, absolutely. And so I just want to mention, we do have some great, I don't know, this is blurry, I'm sure.
Yeah,
But-
it's a little blurry because of the background, but yeah.
Right. But we have some great material that we will send out to those who have questions about our construction to perm loan program. Listen, is there anything maybe that, you do this all the time, something that we didn't touch on that we might need to mention here before I let you get back to your real job?
My real job. No, I mean, it's a fun product. It's a fun process. It can be very stressful for borrowers, but there are some simple things to remember, like land plus the cost to build equals your value. It's a real simple mathematical thought. It's not complex. That's how you get to your value. And from there, just making sure everybody knows what's happening every step of the way, then you're usually in pretty good shape.
Excellent. Well, Cheryl, thanks again. Vice President, congratulations. And really, I know you're very busy, so it means a lot that you took time to do this. And I know it's going to be very helpful for all of our loan officers and for all these folks who are looking to get into this not new program, but this wonderful program that we have. Especially now, it's hard to find homes, right? So start thinking about building your dream home.
Building is the thing. That's right. Thanks for
As
having
usual,
me, Bruce.
Absolutely.
I
As
appreciate
usual,
you.
we'll be reaching out for some help on these. All right. Have a great
I'll
day.
talk with you again.
All right. Bye-bye.
Bye-bye.